Every month the same amount lands in your account. You have come to expect it. You have built your budget around it. You know the date it arrives, you know roughly what it will be, and you have stopped questioning whether that number is actually correct. But here is what the Social Security Administration has never sent you a letter to explain. There is a document, an official SSA form, that a significant number of American seniors qualify to file right now. A document that, when processed, results in a direct increase to the monthly amount deposited into their account. Not a one-time payment. Not a temporary adjustment. A permanent increase that continues every month for the rest of the time they receive benefits. The SSA knows this form exists. They publish it on their website. They process it when it is submitted. And they will apply the increase the moment they receive the paperwork and verify the supporting documentation. What they will not do, and what they have never done, is contact the millions of qualifying seniors who have not yet filed it and tell them they should. The form sits on SSA.gov. The eligibility criteria are clearly published. And every month that passes without filing it is a month that the corrected, higher amount never arrives. Permanently, with no ability to recover the difference retroactively. If you are currently receiving Social Security and your income has changed significantly in the last 2 years, through retirement, a reduction in work, the loss of a spouse, or any other major life event, what comes next may be the most financially significant thing you hear this year. To understand what this document does, you first need to understand a mechanism that affects millions of Medicare-enrolled Social Security recipients and that most of them have never been clearly explained. It is called IRMAA, the Income-Related Monthly Adjustment Amount. And it is the reason that a significant portion of American seniors are receiving Social Security deposits that are hundreds of dollars per month less than they should be given their current financial situation. Here is how it works. Medicare uses your tax return from 2 years prior to calculate your monthly Part B premium. For most seniors in 2026, Medicare is using their 2024 tax return to determine what they pay. If your income in 2024 was above certain thresholds, $106,000 for single filers or $212,000 for married couples filing jointly, Medicare does not charge you the standard Part B premium of $202.90 per month. It charges you significantly more. The IRMAA surcharge tiers for 2026 are substantial. A single filer with 2024 income between $106,000 and $133,000 pays $297.90 per month for Part B. Between $133,000 and $167,000, the premium is $374.20. Between $167,000 and $200,000, it is $450.50. Between $200,000 and $500,000, it is $527.50. Above $500,000, the monthly Part B premium reaches $604.90. For a married couple where both spouses are subject to IRMAA at the same tier, the combined monthly Medicare premium being deducted from their Social Security before they ever see a dollar can exceed $1,000 per month. These amounts are pulled from your Social Security payment automatically. They do not arrive as a separate bill. Most seniors whose deposits are smaller than expected assume that is simply what they receive. They do not connect the reduced deposit to an IRMAA surcharge that was calculated based on income from 2 years ago. And here is the situation that makes this genuinely unfair for millions of retirees. Medicare calculates your 2026 premium based on your 2024 income. If your 2024 income was high, perhaps because you were still working, or because you completed a Roth conversion, or because you sold a property or received a one-time distribution, but your 2025 and 2026 income has dropped significantly because you retired or your circumstances changed, you are paying a 2026 Medicare surcharge based on money you no longer earn. The SSA confirmed this directly on their official IRMAA page. They use the most recent federal tax return provided by the IRS, generally from 2 years prior. And if your income has since dropped due to a qualifying life event, you are entitled to ask them to use more recent income data instead. That is exactly what the document does. The form is called SSA-44. Its official title is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. According to the SSA's official 2026 version of the form, published December 2025, SSA-44 allows qualifying seniors to report a major life-changing event that reduced their income, and to request that Medicare use their more recent, lower income figure to recalculate their monthly premium rather than the 2-year-old tax return currently on file. The life-changing events that qualify are specific and clearly listed on the form itself. Retirement or reduction in work hours. Marriage. Divorce or annulment. Death of a spouse. Loss of income-producing property due to a disaster or other event. Loss of pension income. Employer settlement payment received from a current or former employer due to the employer's bankruptcy or reorganization. Each of these events has one thing in common. They represent a permanent or significant reduction in the income used to calculate your IRMAA tier. And each of them, when properly documented and submitted on SSA-44, gives Medicare the authorization to look at your current income rather than your old tax return when setting your monthly premium. According to Greenbush Financial Group's January 2026 guidance on SSA-44, the process works as follows. You complete the form, indicate your qualifying life-changing event, provide documentation to support your reduced income, and request a recalculation of your Medicare premiums based on your new financial situation. The SSA reviews the request. If approved, your monthly Medicare premium is adjusted to the lower tier that reflects your current income, and your Social Security deposit increases by the difference. For a single filer who retired in 2025 and whose income dropped from $150,000 in 2024 to $45,000 in 2025, the IRMAA tier would move from $374.20 per month to the standard $202.90, a reduction of $171.30 per month. Every month. Automatically. For as long as the lower income figure is maintained. That is over $2,000 per year in additional Social Security income from a single form filing. For married couples where both spouses are subject to IRMAA, the combined savings can run to $4,000, $5,000, or significantly more annually, depending on how far their current income has dropped from the figure Medicare is currently using. There is a second form that produces a different kind of Social Security check increase, and that addresses a situation that is both more common and more overlooked than the IRMAA correction. It is called SSA-561, the request for reconsideration. This form exists for situations where a Social Security benefit determination was made that you believe was incorrect, and where you are requesting the SSA to review that determination and correct it. The most significant use of SSA-561 for seniors who are already receiving retirement benefits involves their earnings record. Your Social Security benefit is calculated based on your 35 highest earning years. If any of those years were recorded incorrectly, if wages were missing, if a W-2 was never processed, if a name change created a records mismatch, if self-employment income was underreported, your benefit was calculated on a lower number than you actually earned. According to SSA Analytics data, SSA 561 is the second most downloaded form on the entire SSA website, with over 5,500 downloads in recent tracking periods. That download frequency reflects the consistent volume of Americans who discover a problem with their SSA determination and need the formal reconsideration process to address it. The reconsideration process works like this. You gather documentation of the earnings discrepancy, old W-2s, tax returns, pay stubs, employer records from the relevant years. You file SSA 561 along with that documentation. The SSA reviews the earnings record against the evidence you provide. If the correction is validated, your primary insurance amount, the base figure from which your benefit is calculated, is adjusted upward, and your monthly check increases permanently to reflect the corrected calculation. How much of a difference can an earnings record correction make? The answer depends on which years were incorrect and by how much. For someone whose record was missing a year of peak earnings, a year in the 1990s or 2000s when they were earning at or near their career high, the correction can add a meaningful amount to the monthly benefit calculation. The SSA's formula applies 32% to the middle band of average index monthly earnings, meaning an increase in average earnings can translate to a direct proportional benefit increase. The time to identify and correct earnings record errors is before or shortly after retirement, while documentation is more accessible and while the window for retroactive corrections is broader. But corrections can be made at any time, and the SSA's official process through SSA 561 is the established path for doing so. There is a third situation that results in a Social Security increase without requiring a separate form at all. But that requires the senior to take a specific action that most have never been told about. It involves the earnings test and the adjustment of reduction factor. Many Americans claim Social Security before their full retirement age. When they do, their benefit is permanently reduced. What most seniors do not know is that if they continued working after claiming early and had earnings withheld due to the earnings test, the $1 for every $2 earned over the annual limit, those withheld months are credited back when they reach full retirement age. According to the SSA's official benefit calculation guidance, when a beneficiary reaches full retirement age, the SSA recalculates the benefit to credit any months in which benefits were withheld due to excess earnings. This recalculation happens automatically, but only if the SSA has accurate and complete earnings information on file for the years in question. If you claimed Social Security early, continued working, and had benefits withheld, verify with the SSA that your earnings for those years are correctly recorded. If any employment income from the withholding period is missing from your record, it may mean the automatic recalculation credited you for fewer months than it should have. Filing an earnings record correction ensures the full benefit of the recalculation is applied. The practical result is that some seniors who claimed early and worked while receiving benefits have been receiving a monthly check that is lower than it should be since the moment they reached full retirement age, because the recalculation was applied to an incomplete earnings record that nobody ever flagged. There is one more document that a specific group of seniors needs to know about, and that represents a correction opportunity created directly by legislation passed in January 2025. It involves the Social Security Fairness Act. As of January 5, 2025, both the windfall elimination provision and the government pension offset were permanently repealed. For seniors who received a pension from a government employer that did not withhold Social Security taxes, state employees, local government workers, teachers in certain states, certain federal employees, these two provisions had been reducing their Social Security benefits for over 40 years. The SSA began processing corrections automatically in February 2025. By July 2025, over 3.1 million beneficiaries had received adjusted payments totaling $17 billion. But the SSA has acknowledged that complex cases are still being worked through in 2026. More importantly, there is a group that the automatic corrections did not reach, and that may represent the largest untapped correction opportunity of all. These are seniors who never filed for Social Security spousal or survivor benefits in the first place because, under the old GPO rules, the offset would have reduced their benefit to zero. For those individuals, there was nothing to apply for. The GPO made the application pointless. That calculation is now permanently different. With GPO repealed, a spousal or survivor benefit that was previously reduced to zero may now be a meaningful monthly payment. Available now, going forward, to anyone who qualifies and files an application. The SSA does not contact people who never filed and tell them they may now be eligible. The eligibility changed. The opportunity is real. But claiming requires knowing it exists and submitting an application to the SSA directly. If you worked in a government job or were married to someone who did, and you either never applied for a Social Security benefit based on that work history or you applied and received nothing under the old GPO calculation, contact the SSA now and ask specifically about your eligibility under the Social Security Fairness Act. The phone number is 1-800-772-1213. The online portal is ssa.gov. Ask them directly. Given the repeal of GPO, am I now entitled to a spousal or survivor benefit I was not receiving before? Here is the picture that emerges when you look at all of these situations together. The SSA calculates your benefit based on the information it has. It applies the rules that are currently in effect. It processes corrections when they are formally submitted with documentation. And it sends your monthly deposit based on whatever the system currently reflects. Whether that reflects a 2-year-old income figure that no longer matches your reality, an earnings record with a gap that nobody ever corrected, a withholding adjustment that was never properly applied, or a GPO offset that has now been repealed. The system does not audit itself on your behalf. It does not reach out when circumstances change that would result in a higher payment. It processes what is submitted. The seniors who are receiving the correct and highest benefit they are entitled to under current law are not the ones who simply trusted the number that arrived in their account. They are the ones who verified their earnings record, who filed SSA-44 when their income dropped, who followed up on Fairness Act corrections, and who asked the SSA directly whether every component of their benefit calculation was accurate. A form takes 30 minutes to complete. A phone call to the SSA takes an afternoon. And the result, for qualifying seniors, is a monthly Social Security deposit that more accurately reflects what the law says they are owed. The document exists. The process is free. The SSA will process it the moment it is submitted. The only thing that has been missing is knowing it was there. This video is for educational and informational purposes only and does not constitute financial, tax, or legal advice of any kind. All information is sourced from SSA.gov official publications. Form SSA-44, December 2025 edition. Form SSA-561, U2. Greenbush Financial Group January 2026 guidance. And the Social Security Fairness Act, Public Law 118-322. Individual benefit situations vary. Always contact the Social Security Administration directly at 1-800-772-1213 or SSA.gov for information specific to your account before filing any form.